Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is January 21st edition of Market Outlook. So, markets certainly in gear. Obviously, it sort of shrugged off or didn't believe the government shutdown. As I'm doing this recording, things are pretty dicey. They're trying to get those in charge there on Capitol Hill to sit down and come to some agreement, but that does not look in the cards. And what's interesting, again, is the markets really shrugged it off on Friday. It's not like this is going to be the shutdown was a big surprise. So uh, certainly, if you take a look at our real motion indicators, momentum certainly in gear. If you look at all the key charts here, everything is in what I would call a positive phase, both momentum and the underlying price structure. Everything really looking good. In fact, we now have a situation where everything is all above their 10-day moving averages, their 50 and their 200, as you can see across the board. IWM tested that 10-day. As you can see, that's the magenta line and bounced off of it, and we've been just accelerating to the upside. Now, that's also true on our weekly charts as well. So as you can see, really strong momentum across the board. So things are in gear. Obviously, you really need to have been in this already. Risk control at this point, really, really tough unless you're purely day trading. So in essence, markets in gear going into parabolic mode, and not much more can be said about that. Now, in terms of price leadership, the Dow has a trend strength indicator of 9 relative to the S&P, which is 6.6. The second strongest index is at the moment the NASDAQ 100. So again, big caps and multinational big caps represented in the Dow is the strongest, which is not surprising because global equity markets in general are in a tear. And in fact, we in the US here are lagging. And I'll get into that in a lot more detail in the premium edition of Market Outlook. And again, NASDAQ 100 growth stocks with a TSI of 7.5. So that's the second strongest major market index that we have. Now, in terms of risk on, risk off, you really can't argue about the overall situation where all of our key intermarket relationships are very, very strong. The one we really like to focus on is the SPY versus utilities. That's a really strong one. Look what's happened to utilities. I mean, obviously rates have gone up quite a bit. That has definitely put downward pressure on utilities. However, stocks seem to be completely unaffected. Now, when we drill down to more key ratios, here we have the SPY versus bonds. Again, stock market, the S&P outperforming nicely. High yield debt relative to the safety of U.S. Treasuries also outperforming. In terms of the anxiety index of looking at SPY versus gold, you got a scenario where the S&P still outperforming gold, and that's a positive sign. We don't like to see gold outperforming the underlying stock index on a ratio basis, and there you have it. You can see the S&P really outperforming. And again, in terms of economic growth and overall inflation, when wood outperforms gold, that's a real positive. That's moving up and showing that there's definitely demand for goods in terms of housing and things like that. And that is definitely consistent considering that housing is actually on all-time new highs. So if you take a look at the sectors, you can see our scenario in terms of sectors. Home builders, right, is actually now in number 3 position. It's up over or just about 20% for the last 6 months, and is putting in a very, very good year to date, actually outperforming the S&P 500. Now, another positive sign about the overall condition of the market: semiconductors resumed its leadership position, up 5% or 4.9% over the last couple of days. Retail, again, which had been really beat up. People were really predicting a lot worse performance here and a bad Christmas and holiday season. Not true. So we now have a situation where retail, XRT, is in second place, measured over the last 6 months, and home builders, right, in third place. So there you have it. And again, the more conservative play here, utilities really underperforming, and year to date down 5%. So there's a 10% spread between the best performing, there's a 15% spread already year to date between the semis and the worst performing utilities, and that is all positive. Now, in terms of volume analysis, you definitely have pretty decent volume. You can see we've got more accumulation days than distribution days, period. And again, 1 week price change, we're pushing mostly between 1 and 2% for the week, and that's a blistering pace year to date, right? You've got a scenario with the NASDAQ 100 up almost 7%. So you can't argue with that overall performance. And again, if you look at all those key intermarket relationships, you can't really argue about the strength of the market. And just again, overall, when you take a look at the market hotspots here, the key thing is that, and what is most interesting is, even though we're on fire here in the US, on a relative basis, China is way outperforming the US. And the same is true on a number of stock indices globally. So we are definitely getting a headwind. And as you can see, again, best performer over the last 5 days was retail in terms of sectors. China on fire, up over 6%. So that's all interesting to note. Certainly the Asian markets and even Japan is starting to move up nicely as well. So bigger picture, right? China, semiconductors. Now what's also interesting is volatility picked up for the week, even though the market moved up. So that may be an interesting pattern to watch. And again, in the premium video here that we're going to get to, there's some real interesting developments in terms of volatility relative to the market, which we get into in more detail. And again, solar still very, very hot, and oil up over 32% over the last 6 months. This week, it took a little bit of a breather, but it's still really hot, looks poised to potentially move a lot further. And again, biggest gainers, solar really doing well. We sort of paused on the week, but not really a major hit to it in terms of its net performance over the last 6 months, which is a key metric for us. And the other thing to note is, right, sugar and a lot of agricultural commodities still in the doldrums, and that's sitting on, basically 100-year lows or thereabout. Okay, that's it for now. Good luck with your trading. See you next week. And if you're a premium subscriber, please click on the premium video to get the additional information.